Good afternoon, everybody, to our November Macro Insights live stream. Normally, we do it from our DBS Spark Studios on a live basis, but this is an unusual one. I'm sitting at an airport lounge at Changi Airport. Chua Han Teng is sitting at a conference room at level 46, I believe, or level 44 at DBS Asia Central. We will do this remotely. Han Teng will conduct the slides, and I will then use the Pigeonhole to track all your questions and answers. The title of this month's live stream is Maintaining Momentum. Normally, no change in momentum is not newsworthy. It's boring, but I think this time it is newsworthy because we're talking about a 6-7 month period when we expected the world economy to slow substantially, and we have more or less gotten that call wrong. The world economy has shown considerable resilience despite historical spike in geoeconomic uncertainty, a lot of back and forth on tariff-related issues and great power rivalry. And despite all that, we're entering the final stretch of 2025 with pretty decent set of numbers around the world. The US is chugging along, as far as Atlanta Fed is concerned, over 3% growth in the third quarter. Europe, which we thought had recessionary risks, is chugging along at one-ish. All of Asia, where we thought there'll be tremendous uncertainty and slowdown in exports, we've gotten that wrong. Exports have been pretty good. And China, despite showing huge weakness as far as exports to the US are concerned, when you take the overall picture of China, it's just done fine. So the fact that we don't have a major recessionary risk, we don't have a complete breakdown in global trade relationship, to me is a big blessing that we should take as we step into 2026. It could have been much, much worse. So what we will do in the remainder of the presentation is I will keep on telling Han Teng, next slide, please, and he'll go to the next slide. So Han Teng, next slide, please. We will go over about a 50-50 presentation. I will talk about a few things related to global economy. After me, Han Teng Chua, our senior economist. Han Teng, you there, right?
Yep, I'm here and listening.
Okay, great to have you, Han Teng. And after me, Han Teng will step in. We released a flagship report about 3 weeks ago called Singapore 2040. It's a big piece of work. About 20 odd people worked on it for several months. It's a 125-page report. Some of the findings are striking. Some of the projections are rather bold. So I will give Han Teng about 20-25 minutes to go over some of the key findings of that. But before that, you have to bear with me for about half an hour or so. Questions? dbs.pigeonhole.at, password macro November, NOV 25, or you can just scan the QR code and send in your questions. We'll look at it after Han Teng's section is done, and we will try to answer as many as we can. If you are having problems doing this right now, don't worry, we'll give you this opportunity several times during the course of this presentation. Next slide. So I will talk about the global economic outlook. Han Teng will talk about the Singapore 2040 report. The QR code that you see on the screen has nothing to do with Pigeonhole. That was the earlier QR code. This QR code will take you to the Singapore 2040 report. We will, I believe, also give you a couple more chances to do that. So don't worry about missing either of these two QR codes. The first one being for Q&A, second one taking you to the website that actually has the Singapore 2040 report. All right, let's get going. Next slide will show you basically the fact that we will, or I will talk about three things: global macro pulse, trade dynamics, and a little bit on climate tech. Nothing to do with exactly where we are in the month of November 2025, but I think some of the seismic developments that are happening on the climate technology area, I think very important to keep track of, particularly since the US is sort of turning away from supporting green transition to a large extent. We want to show you some data that shows what is happening in the rest of the world, and you will be encouraged if you believe in the importance of climate transition with what we have to show you later. All right, so let's talk about the global macro pulse, and we will start with the US. We are talking about for the year 2026 now. 2025 is done and dusted. First couple of quarters, we had some fear of recession. That's all gone. We're going to end the year pretty strong. I think we will probably end up with substantially higher than 2% growth in 2025. And this is an important one, we don't think there'll be a significant deceleration in the US economy in 2026 either. So 1.5 to 2% growth could even be a little higher than that unless there's a big financial market risk manifesting. We'll talk about that several times because to me, that really is the only risk out there right now in terms of the US economic outlook, a financial stability issue. But beyond that, inflation is not going to come down, should be in the high twos, maybe even 3% range. No major progress on the fiscal side, so we're going to look at about a 5% of GDP fiscal deficit, and no major improvement in current account either, despite all the tariff, all the pushback against importing from China and telling the rest of the world to come and invest in the US. We will still see around 3% of GDP current account deficit in the US in 2026. What is extraordinary is, I don't know if I have a slide on that later on, is that although China-US trade balance is turning in favor of the US in the sense that the trade deficit is coming down, US's trade deficit with the whole world is actually going up. So US may choose not to import from China, but that doesn't mean anything as far as its overall trade situation is concerned. Fed, important set of discussions. I hope at least some of you on this call follow our macro weekly. We have been writing about the Fed quite regularly. We wrote about the marginal weakness in the US liquidity market a couple of weeks ago, and we talked about the Fed's quandary this past Monday, especially with respect to its balance sheet. Whether or not it keeps on cutting rates, it will almost certainly head into the world of QE at some point in 2026, in our view, because the system, which expanded a lot, the US Fed's balance sheet, has been brought down to some extent to about 21% of GDP over the last few years of quantitative tightening. Now the system is beginning to show some signs of stress, very mild signs of stress, but the repurchase rate, which is in the US is SOFR, its spread vis-a-vis the effective Fed funds rate is beginning to turn positive. That is the first sign that the market might be just about balanced, maybe even on the margin a bit tight on the liquidity side. And the Fed has noticed it. So on December 1, QT will end. And I don't think there'll be too many months going into 2026 when we'll see actually a QE type operation with respect to buying short-end treasuries. In terms of interest rate cuts, regardless of what Chair Powell and a few other Fed officials have said in recent weeks, they will cut in December, in our view, and they probably will cut again in early 2026. Although I don't think they should be cutting. This is just a prediction of what they would be doing. I don't think, given the growth trajectory and the inflation situation in the US, the Fed should be cutting rates, but it is not operating in a vacuum. There's a lot of pressure from Donald Trump, and the Fed will yield, in my view. If it doesn't, I'll be impressed, but it probably will. That's the expectation, given the way things are going. Two things to watch out, as I said just a second ago, on the financial stability side is the main concern. Within the financial stability matrix, stock market and the private credit market are the risks to watch. Stock market, we all know, valuations are stretched. It's priced for perfection. Even a tiny soft news on the AI side would bring some of these big valuations down to a substantial extent. In fact, today, or rather yesterday, overnight, to be precise, you saw the US stock market, some signs of something like that happening, but I'm talking about a much bigger correction that can actually hit the US economy, not a 2-3% correction. But that to us remains the big risk. On private credit, simply the opacity of the market and the fact that it is also a very big player in funding various data centers around AI. We think that that risk is also something that should be the back of our minds. US dollar holding, we have spent most of this year basically telling our clients and colleagues and internal stakeholders that there is no major de-dollarization story. There is a risk diversification story, that it does make sense to hold a little bit of gold, a little bit of crypto, but it doesn't make any sense to de-dollarize entirely, given the deepest and the most liquid and the most interesting financial market in the world is still very much US domiciled. So investors will keep on holding a lot of US dollar. In addition, as we have said in the past, the stablecoin related issues might even actually help the dollar and the US Treasuries to some extent. But by and large, I think given the way things are on the geopolitical side, it does make sense for a wider spectrum of assets to be held in one's portfolio. European stocks, Chinese bonds, Japanese credit, and gold and crypto, all of those things seem to be there. So that's where we think that the holding of the US dollar and US dollar assets would be flattening. in 2026. Won't exactly go up, but flatten, won't exactly go down either. What about Europe, which seems to become a bit of an afterthought these days? Well, there we don't think things are that bad either. Anybody who's traveled to Southern Europe in recent years knows that Southern Europe has come back strongly from its massive financial crisis about a decade ago. And when we look at Greece, Italy, Spain, Portugal, they are now the big drivers of dynamism in Europe. Germany going through its own economic renaissance on the back of massive public spending in defense, but by and large, there's some risk. France, particularly, I think, has major political issues and some naughty economics-related problems. But by and large, 1%, 1.5% growth, maybe two-ish or maybe even less than two-ish inflation in 2026, likely, which in the greater scheme of things, the key implication is the ECB will remain passive. And as I just mentioned, that there is a lot of regional heterogeneity in consumption and investment. Consumption in Southern Europe looks to be more dynamic than the North. Investment story driven by public push is clearly still a Northern European story to some extent in Southern Europe. We may see some home bias among European investors. They do hold a lot of US assets, and maybe they would want to bring some of that to support their new government issuances in the bond market side. And for a change, there is some dynamism in European equities as well, particularly defense-linked stocks, some tech stocks as well. And it makes sense for risk diversification perspective for European investors to increase their weight on that part of the story. What about China? Well, China also is going to, hey, Hunter, next slide, please. Thanks. In China, again, growth at 4.5 may disappoint some, especially those who have been very used to China growing by over 5-6% a year. But given where China is right now with the property market stress and aging and trade relations with the US worsening, I think the fact that it's growing at 4% is pretty impressive. And I think that the key fear in the case of China, like a debt deflation dynamic, I think some of the worst is behind us, whether it is property market correction or overall sort of slack demand or slack capacity leading to continued downward spiral of prices. I think that's going to be more of a 2025 story than a 2026 story. We'll write about this more in our annual outlook coming out in a couple of weeks' time. In general, the PBOC will accommodate more. In general, the property market is still far from recovering. We might see some regional heterogeneity there, like some parts in China will probably be closer to bottom than other parts. But we don't expect like a massive spike in property prices anytime soon. That doesn't seem to be at all within the aspiration of the Chinese authorities, and they would not necessarily cheerlead a big turnaround in property market anytime soon. They recognize that price correction, balance sheet adjustment, recognition of bad loans, all of that is necessary and would probably constitute a drag to growth, while wealth creation through the equity market, public sector investment, and some degree of consumption resiliency is what's going to drive growth. Overall, structural demand for investment will remain substantial. I don't think China is about to become a hugely rebalanced economy with consumption leading the way and investment following. That may happen down the road, but not anytime soon, definitely not in 2026. This is the key one, the last sentence of my final bullet on China, a gentler approach to dealing with the non-US world, whether it is India or ASEAN or Europe. I think as China finds harder and harder to do business with the US, it will try to secure market share in these parts of the world with tech sharing, tech transfer, 50-50 joint venture, so splitting equities and that kind of stuff, which I think would be a win-win for the rest of the world, which remains very worried about being submerged under Chinese tech supremacy. So if they can strike deals with China on tech transfer and have equity ownership in China, in harnessing Chinese investment, I think it'll be all very good for everybody. All right, what about our neck of the woods, Asia? We're going to see growth maybe slowing a little in 2026 around some hangover around trade, but still trend growth, no issues with inflation, some monetary accommodation here and there. But I think by and large, very few central banks in Asia think that real interest rate is too high or economic conditions are too tight. So I think that monetary policy would not be a big source of speculation or driver of market sentiment in 2026 out of Asia. Japan could be an exception. The BOJ keeps on thinking about hiking rates and normalizing rates, and keep postponing it, that might be an interesting story to follow. But when we sort of travel down from Japan down to China, as I said earlier, some modest accommodation, and then we come down to Southeast Asia, where some rate cuts have taken place already in 2025. I don't think there's a whole lot of action left for 2026. All this could change if we have a big financial stability event out of the US. Then, of course, these authorities will jump in, as they have done in the past. And on the trade war side, US market access frictions probably eases a tad. We've just, on the aftermath of the rather successful, as some say, trip of Donald Trump through ASEAN and North Asia, and his host, Malaysia and Kuala Lumpur, certainly breathed a sigh of relief after he left. There weren't any fireworks. Some questions about the deals that some of these ASEAN countries have signed with the US, including the North Asian countries, Japan and Korea. Have they given up too much of their sovereignty and decision-making to the US? I think many of these governments think of these agreements as not as powerful as legislation, that if two countries sign an FTA and then their parliaments ratify that agreement, that has a much higher order of significance than Donald Trump flying into KL and writing a memorandum, so signing a memorandum between him and Anwar Ibrahim. So I think these countries are sort of going along with whatever the US demands, but that doesn't necessarily mean that they think that they would have to abide by everything the US is asking in a very short period of time. All right, so that's the preview, if you will, of the 2026 economic outlook. We will come back with the 26 outlook in a much greater detail on the 18th of November, but that's when we launch our annual report. Trade dynamics, what are we looking at? So let's think about, so I alluded that whether I was wondering whether I have these charts or not, but I do have this chart. Firstly, what's happening with the China-US trade balance? It's still a trade deficit, but it is coming down quite sharply. We project, looking at January-July numbers, and from that we're projecting for 2025, US-China trade deficit would be just around $200 billion, which will be the lowest in a decade, and a share of GDP, of course, it'll come down sharply. But does that mean Donald Trump is quote-unquote winning? Because his winning, I think, if I'm not wrong, is defined by him bringing down US trade deficit, not just vis-a-vis China, but trade deficit overall. Next slide. And that's where we see the drama. The black bar is the US's trade balance vis-a-vis the rest of the world continues to worsen. So whatever we see in terms of China selling less to the US, that the rest of the world is selling that and more, and therefore in 2025, by our estimate, we'll end up with a $1.4 trillion trade deficit, despite the fact that the US is successfully bringing down its trade deficit vis-a-vis China. What that means, in my view, is that once we actually get this data out at some point in 2026, it would really, really annoy Donald Trump. And he will then go after many countries, but not China, because it's almost like a whack-a-mole game that kids play, right? You've hit on one, China, and you feel that you're getting some results, but everywhere else it's burgeoning. So then you have to hit there, and then some other place will burgeon, and that place you have to hit, and that's the kind of game. Trade whack-a-mole, if you will, in 2026 is very, very likely. Let's look at the trade dynamic from an exports growth perspective. Next slide. So the first two charts that we will look at is what is happening in terms of exports to the US. China is seeing a huge decline, almost 30% on a year-on-year basis to the US, the red line that you see on this slide. But then you look at the likes of Vietnam and Taiwan, they are basically going through a golden age of export jump to the US, exports growing by over 70% for Taiwan, mostly electronics, of course, but also for Vietnam at the rate of 30% or so. Even Malaysia, some basic related recent slowdown notwithstanding, at some point, at most part of this year, was seeing exports grow by 50% or so. Now, some of this is that well-discussed phenomenon of advancing some trade in anticipation of tariffs, and there might be some hangover around that. But the divergence, in my view, is going to be substantial, or it will sustain. US's relationship with China will continue to worsen. US's relationship with the likes of Malaysia, Taiwan, Vietnam will remain very, very strong. There are a few other countries in this region. Let's look at them. Next slide. Right. So I've got Malaysia in here still, same as the left-hand chart, but I've added a whole bunch of ASEAN countries and India from South Asia in this chart. They all track more or less the same. quite a bit of advancing of trade earlier this year, and after that, there's a bit of a hangover taking place. But I don't think these numbers or this recent loss of momentum should worry us. If you put it all together, these are actually really, really good numbers. Things are actually quite weak vis-a-vis the US all of 2023, and it wasn't that impressive in 2024 either for most of these countries. So the fact that things did pick up a lot, and then now they're coming down a bit, but overall 2025 will be still a year where there was a robust growth in exports for most of these countries, and I sort of like that picture quite a bit. Now, what is happening to all these countries vis-a-vis the US, I don't think is a revelation to most people who are on this call. I think this is discussed on paper a lot, in the media a lot. What is not discussed a lot, and Hunting has already jumped into that slide, is what's happening in exports vis-a-vis China. I think that is a far more interesting story to some extent. The US story is expected the way it's happening. You would think that India, given its pretty tense border relationship with China in recent years, will be going through a period of doldrum as far as its exports are concerned. Not the case at all. Latest data show exports are up by over 25% to China from India. We have sort of been picking up and tracking this trend actually over the last 1 year, that while India and China have a bunch of rather thorny issues, unresolved issues at the border, they're definitely not natural allies. India certainly is been trying to be much more aligned with the US, almost as a counterpoint to China. But those things are now being compartmentalized. Those issues are not going to get resolved anytime soon. But at the same time, on trade, on technology, the countries have a lot of mutual benefits to be accrued. And that's what we're seeing. India remains a very large importer of products from China, but now it is also becoming a decently dynamic player in terms of exporting into China. I have Indonesia and Malaysia on this chart too, and they're instructive because these countries both send a lot of commodities to China. And we know that the commodity prices have been fairly lackluster this year, and commodity demand out of China, we know, has not been capturing any market headlines. Despite that, both of these countries are seeing high single-digit growth rate to China. I think that, again, is remarkable and, again, tells us some constructive or reveals to us a constructive narrative as far as Asia is concerned. All right, let's expand this analysis a little further. Singapore to Korea to Thailand to Taiwan to Vietnam. How are they doing? Well, Vietnam going strength to strength. You would think that all this tension would mean Taiwan's exports to China collapse. To the contrary, it's growing. Thailand has been doing pretty well, just coming down a tad lately, but that's more, again, base effect related stuff. Singapore had a bit of a correction, but now it's beginning to recover. It's kind of flattish, but Singapore had extremely strong growth rate to China in 2024. So to me, this is very instructive that while we're fixated on what is happening between the US and the rest of the world, and we're sort of grabbing onto every single news story that is coming up with Donald Trump's demands and how these countries are dealing with it. While all this is going on, trade with the US is one story, but trade with China is a much unheralded story. But to me, that is actually telling us far more interesting things about the evolving nature of a trade war. Okay, my final point of discussion today is the climate tech issue. I don't think I'll have time to go over this when we do the World Outlook launch on the 18th of November, so I might as well do it now. These issues are very close to my heart. I track a lot on what's happening in China, and I've got a few things to highlight in the next slide in terms of China's progress on climate tech. China is leading the world unambiguously on green transition. The country has a massive fossil fuel infrastructure for power generation, coal to gas generated. But that massive infrastructure is not the dynamic part of China's electricity generation story anymore. Coal and gas power generation, in fact, are down 1.3% this year. During the same period, solar, wind, and nuclear are up by astonishingly large amounts, 67% and 22% for wind, solar and wind respectively. And China is sort of not importing as much coal and gas as it used to, down by 13 and 7% this year. And to put it all together, China's CO2 emission is down 1% in 2025 so far. This, in my view, is absolutely remarkable. Poor countries or middle-income countries, as they grow toward their frontier aspirational level of income, they don't reduce carbon dioxide emission. They keep on building factories, they keep on driving more and more cars, they build roads, they build houses. All of that is very carbon heavy. The fact that China is not a high-income economy, it's a middle-income economy, and already it has managed to start reducing carbon dioxide emission, I think is seismic. Equally seismic is the fact that while China has still a big fossil fuel infrastructure and is not sort of stopping to produce coal or gas power generation, but the economy is going in absolutely the right direction when you look at the fact that clean energy generation right now is far outpacing overall power demand. That means everywhere in China where electricity generation is rising, it is being met, more than met, by clean energy. And this, of course, puts the fossil fuel energy infrastructure in China at some risk. I think China has significant stranded asset risk as far as coal is concerned. But all in all, it's a good thing. And the final really, really good thing out of China is the fact that China is now becoming a major consequential player in clean tech exports. China's clean tech exports, by some estimates, have already pushed down CO2 emission by globally about 1% a year. I really cannot think of any other country in the world making such a big difference in exporting clean technology and reducing global carbon footprint, not just their own carbon footprint. So China's story is, in my view, unambiguously positive on climate change and hugely consequential for the rest of the world going forward, both with respect to its own demand and its ability to push down the rest of the world's CO2 emission. Final slide. Climate change is not just an issue related to China. We need to talk a little bit about India, because India is growing very fast. India has a huge population. It will not sacrifice massively on account of green transition. Still, India's story is fascinating. It is consequential because it accounts for 40% of global CO2 emission growth since 2019. So if we don't solve for India, we're not going to make significant progress in the world of CO2 emission decrease. But in India also, clean energy production is surging. CO2 emission from the power sector fell in the first half of 2025. We really haven't seen this in a very, very long time, maybe back in the 70s or something like that. And while in the case of China, clean energy capacity is outpacing overall power demand, India is not quite there yet, but already, given the amount of solar and wind they're adding, it is almost meeting the average increase in power demand. Again, to me, these are extremely consequential developments and gives us a pretty surefire marker that US may be going in one direction. You know, Trump doesn't like wind turbines. He's trying to ban any sort of wind-related projects in the US. US can go in one direction, but as far as Asia is concerned, led by its two most populous nodes, China and India. And also we all know that Europe remains very serious. So I think there's a lot of push in the world to decarbonize, and Donald Trump is not undermining that at all, or is not able to undermine that at all. Okay, I'm going to stop right there. I'm going to pass the baton to Han Teng, and I'll go take a quick look at the Q&A, and please keep them coming. I think the next slide already has the QR code one more time, right, Han Teng?
I think I'll share that again, yeah.
Okay, you will. All right, Han Teng, take it away.
Thank you very much, Tamer, for that very insightful overview of the global economic situation. So I'll now dive right into our Singapore 2040 report that we launched a few weeks ago, and I'll try to unpack the 125 pages in 20-25 minutes or so. Here is the QR code that you can scan to download the report and have a detailed look at the great analysis that our analysts have done over the past months. Here, for any questions, here again is the QR code. And if not, you can head to dbspigeonhole.at and enter the passcode macro November 25. And we'll be happy to answer them at the end of my presentation. So let me now go straight right in. First of all, as a tiny red dot and island nation with no resources, I think Singapore has done remarkably well over the past 60 years since independence. And I think the next phase is to sustain the growth miracle. But let's look at what has happened over the past 60 years. Over the past 60 years, Singapore has done quite well in various aspects in terms of its growth and that has propelled it to be the world's fourth wealthiest nation, with GDP per capita of above 90K. So this compares with the top three, Luxembourg, Ireland, and Switzerland. There are some common characteristics between these rich nations, and I think one of which is related to their financial center status, and that is one that Singapore continues stands out. So over a course of the 60 years since independence, Singapore has gone through ups and downs, as you've seen from the right chart here. But what is remarkable is that Singapore managed to come out of each crisis stronger, and this has propelled its nominal GDP higher over subsequent decades. Most recently, I think the COVID-19 pandemic saw the economy slump significantly to that not seen since independence, but we subsequently had a strong rebound, continue to maintain its position as a trusted node globally. So where we do see the economy going forward, we expect it to leap to a more than trillion US dollars economic size over the next 15 years until 2040. And let me unpack this further. What will power this trillion-dollar leap? I think first of all, while this is a bullish report, we have set quite a realistic growth forecast considering the global uncertainties with respect to protectionism. We are expecting real GDP growth to average 2 to 2.5% from 2025 to 2040, which is around 2.3 over the next 15 years. Compared to advanced economies, that's much faster growth, which is something to be commendable about. What are the key growth drivers that would support economic growth? We continue to think that capital accumulation, drawing in more FDI would be one key factor. The other thing that Singapore has done well, and I think really leverage on the only resource that they have is human resources. And the continuous effort to reskill into adaptation to emerging trends, that's a strength that I think the Singapore economy and its residents and talent here have done so, and this will continue to be sustained over the coming years. I think one key change that would be different from previous years is that TFP would be of less as a drag. Previously has been the drag due to some reliance on low-skilled workers, but that's also starting to be reduced. And there's an increasing focus on artificial intelligence, there's emerging technology, and that could probably allow for better TFP than previously. Now, let me unpeel some of the analysis that we have done in three big key sectors and 5 key focuses in terms of key areas of focus over the next 15 years. I think over the past few decades, Singapore has diversified itself into a services-led economy, and there's a dominance by this different area of services, whether it's in areas of trade, modern services like financial services, starting to emerge as a high IT hub. Those are strengths that will continue to play on over the next decade or so. So Singapore will continue to strengthen its position as a leading high-value entrepot, building on some of the expertise that they have with respect to expansion of Changi Terminal 5, its port that is already leading in container throughput. Global financial hub that could see it cement its position as we expect the gross value added as a share of GVA to rise to around 15%. IT services, just now I talked about harnessing AI. That's an area of focus as mentioned in the National Day rally. and that would see the IT services sector continue to grow. Lastly, I think one key challenge that Singapore, like other advanced economies, would face is aging population. But if you think about it, that also presents opportunity in terms of the healthcare sector, in terms of taking care of the elderly, and that would be a source of area that would support domestic growth over the coming decades. Now, I think one area that Singapore has continued to do well is in terms of its manufacturing sector. And this is when I compare it with other advanced economies that has deindustrialized, Singapore's share of manufacturing sector has also declined somewhat, but still at a reasonable share of around 20% or so. I think amid a more protectionist world, you probably would see some decline. But I think what is crucial for Singapore is that it continues to focus on high value added innovation-led manufacturing. And that is clearly seen in the right chart that I have here, where the manufacturing sector is underpinned by a very high automation, actually second highest in the world in terms of robot intensity. And this will allow for continued growth in the manufacturing sector. And some key areas that continue to be looking at include semiconductors, chemicals, and biomedical clusters. We should continue to have opportunities in these areas that Singapore has been continuously building over the years. Lastly, I can't avoid talking about the construction sector, which over the past few decades has been a key enabler of making Singapore transform into the modern metropolitan city that it has been currently. And we expect the construction sector to continue to boom over the coming years. There is major transport infrastructure upgrades in Changi Airport Terminal 5, the Tuas Port, and progressive expansion of the rail network. Just across our office at MBFC is the expansion of the Marina Bay Sands 4th Tower, and that is also increasing the offerings of the hospitality and tourism sector. And lastly, I think with an aging population and still demand for housing, there are still going to be rolled out of public housing projects that would enhance the quality of life in what is a very advanced economy. Now, let me touch on the 5 key focus areas that Singapore would try to look at over the next 15 years. I think firstly, it will be infrastructure and connectivity. Even amidst a more challenging environment, I think Singapore needs to be continue to be increasingly connected to the world, and this is how it will continue to sustain its relevance in the global economy. And all these positive investments in these major projects would propel the capabilities of Singapore in terms of shipping, aviation, and all this is done not just through technology, but through a sustainable and green basis, where this would continue to support continued higher value added services. The second area of focus would be financial services. Singapore has done quite well as a financial services hub in the areas of wealth management and development, developing itself as a green finance hub in the region. I think these various areas will continue to sustain itself as private wealth continue to be concentrated in Singapore as a wealth, leveraging on its status as a wealth management hub. And I think the 3 local banks here have played to its strengths on this front. Other areas that Singapore continue to lead in include FX trading, but one other thing that the authorities are looking at reviving is the Singapore equities market. I think a couple of moves have been done to try to spur the equity market, whether it's in terms of attracting institutional investors or trying to improve the supply side of things in terms of listing requirements and disclosures. I think all these are positive steps to try to revive the equities market. Thirdly, I think Tamer just now mentioned about climate change, and I think Singapore, even as a small nation, is very committed to climate change, as I think it faced some of the physical threats from probably a more challenging climate environment. I think over the next 15 years, Singapore continues to be highly committed to targeting net zero by 2050. And the energy mix is being transited at this juncture towards more renewables, hydrogen, and imports from regional peers to augment its energy needs. Currently, it's more natural gas, but I think the direction is quite clear from the authorities and the private sector towards a more green economy. And I think another thing that is of key mention is that Singapore is the first Southeast Asian economy to introduce a carbon tax, and that is trying to signal to players in the economy that there is a strong commitment to decarbonize and help the economy decarbonize over coming years. Fourth is in the area of real estate. I think this year what is being released is the URA master plan, and there are a couple of areas that the authorities are focusing on. Things like decentralization, where different work areas and residential areas are being located at different parts of Singapore, as well as looking at a continuous supply of new homes, whether it's on the public and private sector. As the needs continues to be there, our real estate analysts are expecting 200,000 to 300,000 new supply that could come in over the next few years until 2040. And coupled with our expectations of economic growth, I think what you see here is that you still see a steady rise in home prices over the coming years in the real estate space. The last focus area that I'd like to touch on is on demographics and healthcare, which I also briefly mentioned just now. And by 2040, 1 in 3 Singaporeans will be aged 65 or older. While this may be a challenge in terms of fiscal needs, as you see here in terms of government health expenditure, but this may present opportunities in terms of the silver and care economy. And what is being done is to try to cater to the rising needs of the elderly, whether in terms of nursing homes, healthcare needs. All these are things that will be of increased focus as Singapore moves towards a super aged society. And I think Singapore is doing its part to prepare for this more aged society, but let's not be despaired. I think the participation rate of the elderly is also higher as the retirement age is being increased, and encouraging those that are of elderly age to remain active. So I think these few areas will ensure that Singapore try to leverage the experience that the seniors have as well. So what does all this mean for financial markets? I think one of the key things that we have considered in our report is whether the Sing dollar can reach parity with the US dollar by 2040. And I think we consider 4 key drivers of possible long-term appreciation of the Sing dollar. And from this chart, you see here from the 2022 peak, they'll probably need a 30% decline or around 1.5% move per year to reach that potential parity level. What are the potential conditions? I think one is a weaker US dollar, and that is something that is set in motion this year. We have seen a big depreciation in the US dollar, and that amid efforts by Trump to perhaps challenge Fed independence might reduce the US dollar. And Tamer also mentioned about this US holdings plateauing. 3 other factors that are relevant to Singapore is with respect to higher productivity-led growth compared to the US, and that will be an organic driver of Singapore appreciation. And the other one would be safe haven related inflows. Singapore continue to be seen as a trusted and stable node within a volatile economic environment, still attracting a lot of FDI and increasing portfolio inflows. And this will support the Singapore dollar. And lastly, Singapore has been really prolific in terms of being a trading nation, and even amidst the more challenging global environment, it's building on its trading capabilities and connecting with the world. This will continue to support its current account surplus, which will remain still quite robust over the coming years to come. Now, the last point that I'd like to touch on is the Singapore equity market. And what we have seen this year is that it broke a 17-year stalemate. We are probably in the 3rd bull market according to our equity strategies. And what are the conditions that could push STI higher? I think just now we mentioned about Singapore safe haven status. That is coming to also flow into the Singapore equity market. I think after years of probably sluggishness, valuations is remaining quite attractive. Singapore interest rates have come down, so that's might support some rebalancing away from fixed income instruments towards the equity market. And lastly, I think MAS have provided some support measures. So in this report, we think that there's some potential for the Straits Times Index to go up to around 7,000 to 10,000 level by 2040, resulting in perhaps higher returns, continue having a nice dividend yield of 5%. And I think companies, by and large, also trying to take bolder strategies in terms of internationalization. Is this a realistic level that Singapore can reach? I think it's one that is conservative based on our analysts' estimates of 5% EPS growth over the next 15 years and a forward PE of 40.5, which is near average or so. So these are all conditions that could propel the STI higher. I mean, to sum up, this is quite a flagship and massive report that we have come out. And I think 3 key takeaways that we would like our participants to have is that Singapore would remain to be very attractive, trusted, and a stable location for investments amidst a very uncertain world. And we think that will propel the economy to more than $1 trillion level by 2040. And secondly, I think that there is some conditions for potential US Sing dollar parity by 2040. And lastly, I think the equity market is in a revival phase and is embarking on a new bull market and potentially could near 10,000 by 2040. Now let me pass back my time to Tamer, who would help and we'll be happy to answer some of the questions that you may have. Thank you.
Thanks. Thanks very much. Maybe I ask you a question before I get into the questions that everybody else has asked. So this Sing dollar, US dollar parity, I have also been sort of hearing a lot of questions from clients on this issue lately. It is a medium-term call. There could be periods when actually the Sing dollar weakens because MAS at the end of the day does pursue monetary policy through the exchange rate. So it's not a call that on a steady basis it appreciates, but that there'll be areas around which they can also depreciate sometimes. So with that context, Han Teng, in your view, in the next 12 months, if we see the Fed cutting a bit, doing QE, is that still a conducive environment for Sing dollar appreciation?
Yeah, so I mean, you rightly pointed out that it wouldn't be a smooth path towards parity. There would be ups and downs. I think by and large, what we have seen perhaps is some correction in the US dollar Sing pair towards 130. But I think with conditions like you mentioned, if the Fed continue to cut rates, some form of QE, that would push the US dollar lower. But also on the Singapore dollar set of things, I think the Singapore economy by far in 2025 has done quite reasonably well. And in 2026, I think, okay, you may say that there's some trade headwinds, the economy might slow, but there are still probably some factors that would be supportive, perhaps in the areas of tech, finance. So MAS would probably keep itself flexible in terms of its monetary policy. And I think continued modest appreciation of the Singapore dollar, basket is still a reasonable thing that we can consider. And if you put all these factors together, I think together with Philip, our FX strategies, we think there's still some room for appreciation in the Sing dollar over the next perhaps 12 months in 2026. And
right. No, I fully concur, Han Teng. I think that Singapore's FDI environment remains very favorable. The amount of investment that will be deployed in semiconductors and servers and the manufacturing demand for the various chip industries that Singapore has, electronics industry that Singapore has, chemical refining, I think the export outlook would be pretty robust. And the investment outlook, whether it is the fact that Singapore's financial markets, particularly SGX, is looking quite buoyant, new capital allocation in that area, that again would be a Sing dollar positive development. And to your point, the growth performance for 2025 gives one a lot of confidence that even faced with a lot of geopolitical uncertainty, Singapore can deliver a pretty decent growth momentum. Again, I think would be favorable toward the Sing dollar's outlook. All right, a couple of more questions. The first question is on QE. When and how will the Fed resume QE? Well, step one is the step of ending QE, QT, December the 1st. The Fed has already said that whatever proceeds it will get from retiring mortgage-backed securities, it will start plowing into short-term US Treasuries, which must be a great piece of news for Treasury Secretary Bessent and Mr. Trump, because they do want the US fiscal deficit to be financed in an orderly manner, and the Fed doing that by taking proceeds from MBS and putting into treasuries would help in that direction. I think that the current size of the balance sheet, about 6.6 trillion, about 21% or so of GDP, may not prove to be sufficiently liquid, especially if we see the SOFR effective Fed funds rate spread beginning to continue to widen. And that's the reason we think that by the end of the first quarter of next year or early second quarter next year, the Fed will resume QE, not in a very big way, because there's no crisis to speak of, unless there's a massive stock market correction, but just around the idea that maybe at 6.6 trillion, the balance sheet is a bit tight, as proxied by the SOFR EFFR spread. We have a couple of more questions. Oh, one on carbon emission. How have the G7 nations been performing this year, especially the US? Well, the US is not doing very well. I wouldn't put all the blame on Trump. I think there would have been an AI data center related demand for the increase in demand for electricity in any case, with or without Trump. But the fact of the matter is the US will actually end 2025 with an increase in carbon emission, despite all the effort made in the EV infrastructure and green energy over the past decade or so. The IEA in its report suggests that they think that there could be a reduction next year as more power is generated through gas as opposed to coal. It remains to be seen. I don't know if IEA is actually fully on top of the massive scale of investment that is happening around power generation across various sources, because there's so much demand from the AI space. We do know that electricity tariff in the US is rising. That again demonstrates significant additional demand, and some of that demand will be met through heavy carbon emitting energy generation. So no, the US is certainly not as good a story as it is for China. The rest of G7, particularly the European countries, they are more or less on the same track that they were before. Still massive amount of investment happening in wind and solar. Nuclear, a lot of talk. Actual action, I think, is many years away. It's very expensive and time consuming. So we shall see. All right, one final question. How do you see the outlook for the US dollar following the recent rebound? It's a very short-term tactical question. We think that the dollar could have some additional room to grow or strengthen in the very near term, simply because we think that if we see some resolution around the government shutdown, that could be dollar positive. If we see the third quarter wave of earnings reports continue to be on the good side, and the Christmas related sales seasons looking good. In the absence of government data, we're relying increasingly on alternative data. San Francisco Fed has some data on labor market that seems to suggest it's good, so that could also be slightly more dollar positive. And finally, if indeed we see sustained pushback from a number of Fed officials on the necessity of significant additional rate cut or policy easing, that certainly would be dollar positive as well. So we're not dollar negative in the very short term. Sing dollar, US dollar is a different story. We're just talking about the overall dollar complex. And there, I think the room for any major weakening in the very near term is small. There will be many factors driving US dollar next year, including the massive deficits and so on, but that's later. I think the question is about the very short term. Okay, I think we have run the course of this live stream. I'm glad me sitting in an airport lounge and Han Teng sitting on level 44, it all worked out. Thank you very much, everybody, for dialing in. We will come back to you in just a couple of weeks' time with our annual outlook. Until then, thank you very much, Han Teng. And thanks to everybody who dialed in. Stay healthy, stay safe. Bye-bye.